Welcome to the deep dive. Today, we're zeroing in on Box Inc. You know, the intelligent content management platform.
That's right. We're looking at their first quarter results for their fiscal year 2026. The quarter just wrapped up end of April.
And we want to cut through the noise, really understand how they're doing and where they might be heading.
Exactly. We've got a few sources. There's a Benzinga article via Mumu, gives a nice overview.
Okay.
But the real core stuff comes straight from Box's investor relations, their official press release, and importantly, their earnings presentation slides.
Perfect. So our mission here is basically to distill all the key numbers, the strategy talk, the outlook into something clear and concise for you.
Let's do it.
Okay, let's dive right in. The big number first, revenue. How did Box stack up?
Pretty well, actually. Revenue came in at $276.3 million for the quarter.
$276.3 million. And how does that compare to, say, last year?
It's up 4% year over year. If you look at it on a constant currency basis, it's actually a bit better, up 5%.
Okay, solid growth. Did
Yeah.
it meet what people were expecting?
Yeah, that's the good news. It beat both Box's own guidance and what analysts were predicting. The street was around $274.8 million, so a nice beat there.
Always good to see a beat on both. And looking at the trend from the presentation, revenue was climbing last year, right?
It was. They had Q1 45 at 265 alums, and then $270, $276, and beat in Q4 at $280. So this $276 is a slight dip from that Q4 peak, but still up from Q1 last year.
Right. Context is key. Okay, so top line looks decent. Let's talk profit. Earnings per share, EPS. What's the story?
Well, it's a bit of a mixed bag here. Let's start with non-GAAP EPS. That was $0.30.
30 cents. How did that fare against estimates?
Better than expected. The consensus was around $0.0926, so they beat that.
Okay, another beat. But I sense a but.
Yeah, but it's down from last year. Q1 last year, they reported $0.39 non-GAAP EPS.
Quite a drop. Why the decrease?
Box is pointing mainly to deferred tax expenses. That's a big factor. And also some impact from foreign exchange rates.
And GAAP EPS, similar story.
Pretty much the same trend, yeah. GAAP EPS was $0.02, just 2 cents. That's down from 0.08 cents in the same quarter last year. And again, those deferred tax expenses are cited as a key reason.
Okay, deferred tax expenses. You mentioned it twice now. Sounds important. Can you, quickly break that down? Why is it hitting their numbers now?
Sure. Think of it simply. Companies often have losses from past years that create sort of tax credits or benefits they can use later when they become profitable.
Right. Tax loss carry forwards, that kind of thing.
Exactly. Box has become consistently profitable now, which is great, but it means they're starting to use up those past benefits. So the accounting requires them to recognize a tax expense now, even if the cash payment isn't immediate.
Got it. So it's an accounting thing reflecting their sustained profitability, but it lowers the reported EPS number for now.
Precisely. It impacts both GAAP and non-GAAP in their case.
Okay, that makes sense. Let's move to a forward-looking metric. RPO, remaining performance obligations. How's that looking?
This looks really strong, actually. Total RPO hit $1.469 billion.
Wow, almost $1.5 billion. How's the growth there?
Really impressive. Up 21% year over year. Even adjusting for currency, it's up 17%.
That's significant growth. Does the breakdown tell us anything more, like short-term versus long-term?
It does, and this is quite interesting. Short-term RPO, so revenue expected in the next 12 months, is $812 million. That's up a healthy 13%.
Okay, solid.
But the long-term RPO, revenue beyond the next year, is $657 million. And that's up a massive 32% year over year.
32% on long-term. That really suggests customers are signing longer deals, right? Locking in for the future.
Absolutely. It signals strong confidence and provides really good visibility into future revenue streams, potentially lowering churn risk, too. The trend charts in their deck show this building nicely.
Definitely a positive signal. Okay, what about billings? How did that metric perform in Q1?
Billings landed at $242.3 million. That's also strong growth, up 27% compared to last year, or 17% in constant currency.
27% growth, that's quite high. But looking at the trend chart, there was a huge spike in Q4, wasn't there? This Q1 number is way down from that.
You're right. Q4 billings were nearly $400 million. It's pretty typical for software companies, especially enterprise-focused ones, to have a really big Q4 as deals close before year-end or budget cycles align. Then Q1 often sees a seasonal dip.
Okay, so that sequential drop isn't necessarily alarming given the seasonality.
Exactly. The year-over-year growth is probably the more important figure here.
Got it. All right, let's look at the profitability of their core service. gross profit and gross margin.
Yeah, fundamentally very healthy. Non-GAAP gross profit was $222.3 million. That translates to a non-GAAP gross margin of 80.5%.
Over 80%. How's that
Fine.
compared to last year?
Slightly up. It was 80.2% in Q1 last year, so holding very steady at a high level. The trend over the last 5 quarters is consistently in that 80-82% range.
And GAAP gross profit?
Also strong, $215.6 million, which is 78.0% margin, same percentage as last year. It just shows their core content management offering is inherently profitable.
Okay, high gross margins. What about overall operational efficiency? Operating margin.
Here we see a bit of a dip compared to last year. Non-GAAP operating margin came in at 25.3%.
And last year.
It was 26.6%. Box attributes this decrease to making strategic investments back into the business, investing for future growth.
Right, the classic trade-off. Spend now for potential gains later, and the GAAP operating margin.
That saw a larger drop, relatively. It was 2.3% this quarter, down from 6.8% last year. Again, influenced by those deferred taxes and investments.
Okay, so margins are slightly compressed due to planned investments. How about cash flow? Did they generate good cash?
Yes. Still strong cash generation. Net cash from operating activities was $127.1 million. That's down slightly, about 3% from last year.
Free cash flow.
Non-GAAP free cash flow was $118.3 million, also down a touch, about 4%. So slight decreases, but still generating substantial cash.
All right. And one last financial metric for now, deferred revenue. How did that look?
Deferred revenue stood at $574.1 million at the end of the quarter. That's up 12% year over year, or 9% in constant currency.
And that growth aligns with the RPO picture, suggesting future revenue is building.
Absolutely. The trend chart shows it increasing steadily, which reinforces that positive outlook from the strong RPO numbers.
Okay, that gives us a really good handle on the key financials. Let's switch gears a bit. What's driving these numbers? What were the big strategic moves or highlights for Box in Q1?
Well, the big headline, and you hear this directly from CEO Aaron Levy, is AI. It's everywhere in their messaging.
No surprise there, I guess. How are they positioning themselves?
They're really leaning into this idea that we're in an AI-first era. Box sees itself as the platform that helps businesses actually unlock the value hidden in all their unstructured data, documents, presentations, videos using AI. Their intelligent content management platform is key to that.
So they're not just a storage box anymore. They're the intelligent content platform for the AI age. What specific AI things did they launch or announce?
They unveiled quite a bit. The main thing was a set of new AI features, including what they call AI agents.
AI agents, what do they do?
Think of them as tools to help with intelligent search across your content, doing deeper research within documents, and improving how you extract data.
Okay. And what's powering these agents? Are they building their own AI models?
What's interesting is their open approach. They highlighted integrations with a whole range of models and platforms, IBM's Watson-X, Google's Gemini and Gemma, Meta's Llama, OpenAI, even xAI's Grok.
Wow, that is broad. So they're aiming for flexibility, letting customers potentially use different underlying AI tech through Box.
Seems that way. It avoids vendor lock-in on the AI model side and lets them leverage innovations from across the industry.
Smart. Now, besides their own features, you mentioned partnerships are key. What did they announce there?
Yes, strategic alliances seem huge for them. They announced tie-ups with IBM, integrating with Watson-X. With Google, through something called Agent Space.
Agent Space.
Yeah, and with Salesforce, integrating to their Agent Exchange and also their life sciences partner network. And ServiceNow, too, weaving Box AI into their platform.
So embedding Box AI capabilities directly into these other major business platforms.
Exactly. The goal seems to be making Box content intelligence readily available within the workflows users are already in, driving insights and productivity there.
Makes sense. Get the intelligence to where the work happens. Any other big milestones for the business this quarter?
A really significant one, especially for government business, was achieving FedRAMP high authorization.
Ah, yes. That opens doors for handling highly sensitive government data, right?
Precisely. It's a big deal for expanding their footprint in the public sector. They also launched something called Box Archive.
Archive for long-term storage.
Yeah, it's for their enterprise advanced customers. Lets them securely retain inactive content for compliance or long-term needs without cluttering active workspaces.
Practical. Anything else?
They also rolled out Box AI for mobile, bringing those AI features to users on phones and tablets across their business and enterprise plans.
Good to see mobility included. Were there any notable customer wins they highlighted?
They did. They mentioned wins or expansions across a bunch of different sectors, names like Boeing, Kawasaki Heavy Industries, Wendy's, Regeneron Pharmaceuticals.
Diverse group.
Yeah, and even the U.S. Army Civilian Human Resources Agency.
Yeah.
It just shows the wide applicability of their platform, from aerospace to fast food to life sciences to the public sector.
That diversity is definitely a strength. We talked earlier about revenue growth being driven by their suites. Can you expand on that? What exactly are suites and why are they important?
Right. So Box reported that 61% of their total revenue now comes from customers buying their bundled suites. These packages combine various features like security, governance, workflow, e-signature into tiers.
And that 61% figure is growing.
Yes, the trend chart shows it climbing steadily over the past 5 quarters. Box argues these suites simplify things for customers, address high-value needs, and potentially reduce overall costs compared to buying point solutions.
So the strategy of bundling seems to be resonating well with customers.
It appears so. It drives higher average revenue per customer and likely increases stickiness too.
Speaking of higher value customers, how are they doing with attracting and keeping the big spenders?
They're doing well there too. The number of customers paying over $100,000 per year grew to 1,940.
1,940. And the growth rate.
That's up 8% compared to last year. Their presentation materials emphasize this steady growth in large accounts as a key strength.
An 8% growth in $100 K plus customers is solid for enterprise SaaS. What about overall customer loyalty, net retention rate?
Still looking good. They maintained a quarterly net retention rate of 102%.
102%. So existing customers are not only staying, but spending slightly more on average.
Exactly. It reflects upsells, cross-sells, or expanded usage within their existing customer base. And importantly, their overall churn rate remains very low, reported at just 3%.
Over 100% NRR and 3% churn definitely points to a sticky platform and happy customers.
It certainly suggests that.
We also saw they're continuing to buy back their own stock.
That's right. They spent $50 million in Q1 to repurchase about 1.6 million shares.
And they still have authorization to buy more.
Yep. As of the end of April, they had about $152 million left under the current buyback program. It's a way to return capital to shareholders.
Okay, so that covers the recent past and present. Let's look forward. What guidance did Box give for the upcoming quarter, Q2?
For the second quarter of fiscal 26, they're forecasting revenue between $290 million and $291 million.
$290 to $291 million. How does that compare year over year?
At the midpoint, that's about 8% growth year over year. Adjusting for currency, it's around 6% growth at the high end. They actually expect a slight positive impact from foreign exchange in Q2.
Okay. And profitability expectations for Q2. Operating margin.
They're guiding for a GAAP operating margin around 6.0% and non-GAAP operating margin around 28%. That 28% also includes the expected FX benefit.
28% non-GAAP op margin, pretty strong. What about EPS for Q2?
GAAP EPS is expected to be very low, just $1 and $2.02. Non-GAAP EPS guidance is $0.30 to $0.31.
And again, that low GAAP number and even the non-GAAP guidance includes the impact of those deferred taxes, right?
Correct. They're making sure investors understand that deferred tax expense is baked into these projections.
Okay. What about the outlook for the full fiscal year 2026?
For the full year, they expect revenue to land between $1.165 billion and $1.170 billion.
Which translates to what kind of growth?
That's about 7% year-over-year growth or 6% on a constant currency basis, then assuming FX will be roughly neutral for the full year.
And full year operating margin guidance.
They're projecting GAAP operating margin around 7.0% for the year and non-GAAP operating margin at approximately 28.0%.
Same as the Q2 non-GAAP guidance. Interesting.
Fair.
And full year EPS. Still feeling the tax impact.
Definitely. Full year GAAP EPS is guided to be $0.16 to $0.20. And non-GAAP EPS is expected between $1.22 and $1.26. And yes, both ranges explicitly include the negative impact from recognizing those deferred tax expenses throughout fiscal 26.
So it's clear this deferred tax situation isn't just a Q1 thing. It's going to be a running theme affecting their reported EPS all year.
That seems to be the message. Underlying operations might be strong, but this accounting standard will keep the reported EPS figures lower than they might otherwise be.
What's the overall message from Box management about their long-term prospects, despite this?
They emphasize having a proven, resilient business model. They stress their focus on driving both growth and profitability, suggesting they're confident in the long-term trajectory.
Okay. Lastly, let's touch on what the analysts are saying. How is Wall Street viewing Box right now?
It's pretty mixed, actually. According to that Benzinga article, the average one-year price target is around $36.
$36. And where's the stock trading now? Does that imply upside?
Yeah, based on current levels, that 36 hours average target represents a potential upside of roughly 14.4%.
Okay. Decent potential upside on average, but
Yeah,
you said it's mixed.
very mixed. Analyst ratings range from bearish to bullish, and the price targets themselves are all over the place. The article mentions a low target of $21 and a high target of $45.
Wow, $21 to $45 is a huge range. That really tells you there's significant disagreement among analysts about the company's value and future.
Absolutely. It reflects different views on their growth potential, the impact of AI, competition, the macro environment, and how much weight to give those deferred tax impacts. Lots of variables.
No kidding. It really highlights the challenge of valuing tech companies right now. Okay, well, that was a thorough deep dive into Box's Q1 results. Let's try to quickly sum up the key takeaways.
Sure. So Box beat revenue expectations for Q1, driven by their ICM platform and especially the momentum in their suites offerings.
Right, and AI is clearly a massive focus, with new features and significant partnerships announced.
Definitely. On the downside, while non-GAAP EPS beat estimates, both it and GAAP EPS were down year over year. That's largely due to those deferred tax expenses becoming a factor now that they're consistently profitable.
And that tax impact is going to continue throughout fiscal 26 based on their guidance.
Exactly. So strong underlying business metrics like RPO growth and customer retention, but the bottom line EPS numbers are being visibly affected by accounting changes related to past performance.
So thinking ahead, Box is betting big on AI and these integrations. How might that fundamentally change what their platform is? Could they unlock totally new value streams for businesses drowning in documents and data?
That's the billion-dollar question, isn't it? And on the flip side, how will investors continue to react to the profitability picture with those deferred taxes muddying the waters, even if the core business remains strong?
Yeah, definitely some interesting dynamics to watch. Plenty to think about there. Thanks for joining us for this deep dive.